My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends? Just trying to make you some money. My job is not just to entertain, but to educate, teach, put days like this into context. Call me at 1-800-743-CBC or tweet me at Jim Cramer. In retrospect, were we paying too much for everything? I mean, that's Wall Street's conclusion on a day where the averages got slammed again, but still rebounded from their lows. Dow finishing off 67 points, 1 point positive. The S&P declining 1.22%. The NASDAQ, forget about it, tumbling another 2.28%. But I'm not satisfied with that too expensive explanation, too glib, even as people right now are trying to dump Microsoft as if it's a bag of red-hot charcoals. So let me give you the autopsy of this decline over the last couple of months. Let's call it since November, so you understand, make it a little less emotional. For years, I've warned you that nothing is more dangerous to a bull market, nothing, than supply. A stock market's like any other market. If you get too much inventory, prices will plummet. Of course, even when you get too much merchandise, too many IPOs, too many specious SPAC deals, it's hard to turn off the spigot because there's so much money on the line for the bankers, for the venture capitalists, and, of course, for the promoters, the private equity people, all the rich people, okay? Now, that money is all behind the scenes. I, fortunately, have some insight into how it works because I actually went through the process myself when I brought public TheStreet.com, an outfit that I started in 1995 and left last September after a decent 26-year run. First, you have an idea, and you talk about how it can scale, becoming the first mover in a disruptive category. So you go out west to a bunch of venture capitalists. They love you. They lap it up. They give you money, and that establishes your valuation. With The Street, it was surreal. Suddenly, our enterprise was valued at $25 million. I had about 500 subscribers. Good lifetime valuation, I was told. Then a few months later, with some decent uptake of our products, the venture capitalists valued the company at $125 million, after we'd already spent and lost the initial round of funding. Next thing you know, we had a few more meetings, more investors, some journalism big shots, and now we got a $150 million valuation. $25 million to $150 million in almost no time flat. More and more money gets lost until you finally come public and the stock opens at $1 billion valuation. Because there are many people who like the product and buy the stock using market orders. The investment bankers keep back a lot to generate a, boom, vicious pop. Needless to say, it should never have been worth that much. Fast forward a little bit, you have another losing quarter, except this time your publicly traded stock gets slugged, then another with another beatdown, and eventually you find your company losing money with a stock in the single digits, trading slightly above cash, no institutional support whatsoever, and a lot of pride mixed with self-hatred. And hey, that's actually one of the better outcomes. I kept that company alive. There were more than 300 companies that came public during the dot-com era, and nearly every one of them had a similar trajectory, and almost none of them made it. Looking back, we got a high valuation on our own supply, thanks to the valuations that were created by the venture capitalists and the syndicate desks that engineered these IPOs so they could get a lot of money for the companies that backed us. I never spoke to anyone after the last round of pricing. I was always amazed that the VC guys kept paying up for the same merchandise. They almost did it to seem to make money for themselves, I thought. Keep raising the price and then bail on the silly public. It was beyond me. Could anyone really be that greedy? I mean, we were losing a ton of money. But you know what? Those guys made out like bandits. Well, guess what? Out of nowhere, we saw the same darn thing happen over the past couple of years. 400 IPOs last year alone, many of which actually look a lot like TheStreet.com in the late 90s. Ridiculous venture capitalist valuations, then sky-high stock prices right out of the gate. Wall Street promotion machine kicking in full gear, just like The Street. Worse, we had something like 200 SPAC deals. They're still trying to pull them off, where lots of private equity firms get involved, big shot guys who can really call a lot of tunes. And there was a ton of hype, including ridiculous projections that the SEC says probably shouldn't have happened. These companies have no institutional support now, and you have no idea how they're really doing or who really profited in the SPAC pipeline. They're almost all disasters. The SEC needs to shut them down. They are outrageous, and I've decided that I have had enough. I can't take these losses anymore. Someone has to stand up to these big-time promoters and money men and women, and it might as well be me, because I don't play for dinner. Now, I want to believe that many of last year's roughly 600 new listings are better than the 300 that we got in the dot-com. But the recent action tells me they aren't. These broken IPOs have emptied the pockets of investors, and they're now tired of losing. Yet they're selling their winners to fund the overhyped losers rather than take a hit that's really already been taken for them. On top of that, you now have a host of companies that most people have no idea how to value. I mean, sure, there were lots of crummy enterprises that never should have gotten through the IPO chute, but there were hundreds more that totally caught the fancy of Wall Street because they had tremendous revenue growth. They all seem to have similar characteristics. They were cloud-native software providers that offer something as a service and secure data while helping customers in a secure way with a 360 approach to all things digital. We've had so many of these cloud deals that we simply stopped being able to value them on anything but press releases and sales forecasts for the out years, very much like the end of the dot-com era. The promoters tried to figure out new ways to pitch them, enterprise value to sales, Tesla's similarity per share. Those superlatives, they ran out in November. And in the end, at the very top of that month, it was all about raising price target. That's a double-edged sword. And now cutting price target is the only mention you hear, at least for the ones that anyone still talks about. Given that many of these newly public stocks are bunched into stupid ETFs, their individual price target cuts can drag down a host of other names in a vicious cycle downward. These newly minted stocks and SPACs are now killing us. It's the excess supply that's dragging down the rest of the market. Sometimes I wish we had some sort of minor league stock market so we could kick them over to that. You know how in soccer over in Europe, they send them down to another league. We need that here. Finally, there's the ultimate indignation, the actual companies, the good ones. The real ones. The ones that are being tarred with the same broad brush as the bad ones, even as they deliver excellent results. Last night, IBM reported its best quarter in 11 years. Stock opened unchanged. Everyone's so negative. Then Wall Street comes with census. IBM roars. American Express reports the best quarter in the 37 years of CEO Steve Squeery's tenure there. And the robo headlines say that he missed the revenues. Conference call explains its stock skyrockets. Johnson & Johnson delivers a quarter that is incredible given COVID, and the robo headlines say it was bad. The stock's down big, and then it reverses, jumps gigantically as people realize they're getting a bargain. Raytheon Technologies reports an eye popper, one that, like all the others, I loved, but the media instantly dumped on it, thought I was wrong, spoke to Greg Hayes, the CEO, and bingo, way up. Texas Instruments crushes it tonight. Stock gets crushed itself. Why? Because idiots don't bother to listen. And then when they hear it, they gobble up every share. Okay, we got clunkers. JP Morgan laid an egg. I bet that Jamie Dimon's probably buying a million shares right now. Many, not me, many think that Microsoft's done, stick a fork in it, cloud business allegedly downtick. I'll wait and see. Yeah, General Electric was hard to understand, so it got sold. And Netflix made thousands of stocks look bad, when it really should have only made Netflix look bad. But if you sit back and calculate the winners, that includes United Health, Morgan Stanley, Bank of America, Halliburton, Union Pacific, Lockheed Martin, along with today's class, then you recognize that the players on the scout team, the ones with the red pennies, the kids who got picked last and those who missed practice, they are all there, wrecking it for the rest of us. And there's far fewer of them in the majors. See, the bottom line, when you look at the majors, the real companies with real earnings that are reported so far, the winners actually outnumber the losers 13-4. And if I want to add Verizon, I can make it 14. Hey, why not throw in Travelers? That was great, but nobody cares about insurance. So now I got 15-4. Pretty amazing considering that I can't even find 15 good companies out of the whole 600-odd enterprises that came public last year, especially the farcical SPACs that need to be banned. They are laughing at you. You don't think they are, but they're laughing at you. They're so rich, and they're laughing. Looks like history really does repeat itself. First time it's dot-com tragedy that I got caught up in. Then it's cloud-based farce. Jonathan in New York. Jonathan.
Oh, yeah, Jim. I got a good one for you today.
Oh, a SPAC? I hope it's a SPAC.
Amazon has an overweight buy rating and a price target of 4,000 among other hedge funds. So do we hold or do we buy more dip to get rich?
Which one?
Amazon.
Oh, Amazon. All right, look, Amazon's right now on a go-down mission. Everyone's dumping on Amazon. People are saying they're selling Amazon. You know what? We've owned Amazon forever for the Travel Trust, and we're not going to sell it down because we think it's one of the greatest companies ever. Sorry. I mean, look, Warren Buffett thinks Coca-Cola is one of the best. He owns everyone says, wow, he's great. That stock isn't doing anything. At least Amazon's doing something. I refuse to capitulate to the crowd. I smell their grease paint, and I hear their roar, and I think they're wrong. Mike in Louisiana. Mike.
Booyah, Jim. This is Mike from Shreveport.
Oh, man, I love Shreveport. I love Shreveport. It's underrated. I got to tell you, I loved it. What's going on?
Man, I've been a fan of the show since May of 2005.
Thank you.
So anyway, I started a position in this stock six weeks ago. Man, it's been dropping ever since and real hard. While I've been buying a little with each dip, I'm beginning to wonder, Jim, should I buy, sell, or hold NVIDIA?
NVIDIA is a long-term situation. Historically looks expensive. When we see the numbers, it's not. What's the matter with NVIDIA? A lot of people right now, it and a couple of its brethren got overextended at the very top. People got way too enthusiastic. But you know what? That enthusiasm is being wrenched out of the stock. We own it for the trust. We own a bunch of winners, some of which we trimmed, and some of which we just say, you know what? We're going to be in there as long as the same management team is in there, and that team continues to deliver fantastic product for the consumer and for the enterprise. And that's what NVIDIA is doing. Right. Nothing is more dangerous to a bull market than supply. And these newly minted stocks and SPACs are ruining it for the rest of your portfolio. When you look at the real companies that have reported so far, I got about 15 winners and 4 losers, and I'm telling you something, I know how to count. Made money tonight. Verizon beat earnings expectations for the fourth quarter. I'm digging into the numbers with the CEO. Then it's Tale of Two Railroads, Union Pacific versus CSX. But which of the two could represent the best buy in this market? I'm tracking the two and giving you my take. Hey, by the way, Logitech, glimmer of green in today's session after reporting spectacular third quarter results last night. I'm getting the latest from the company's top brass. Remember, far more winners than losers among the real companies. But the rest, it's David Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Shepard Smith here. Thanks for watching CNBC on YouTube.